Open the American Tax Code to Section 401. Skip past subsection A, past B, past C, keep going, and you will find a paragraph labeled K. A few hundred words of accounting language about deferred compensation. It never mentions retirement, and it never mentions you. What nobody understood in 1978 was that this throwaway paragraph would quietly become the entire retirement system of the richest country on earth. But nobody voted on that, and the man who built the first one calls it a monster. Rochester, New York. 1978. Eastman Kodak owns this city the way a mountain owns a valley. Film plants running around the clock, parking lots the size of neighborhoods, chemical towers venting steam into the gray upstate sky. And every year, Kodak hands its workers a bonus check large enough that people in Rochester use them to buy cars, which sounds wonderful until the tax comes out. A factory worker gets that check, watches a fat slice vanish before it reaches the bank, and starts asking his congressman whether there is any way to hold on to it. That congressman is Barber Conable. He graduated Cornell at 19, went into the Marines, came back, became a lawyer, and ended up as the ranking Republican on the House Ways and Means Committee, the room where American tax law is actually written. He decorated his office with tomahawks because he liked the idea of cutting things down. And in the summer of 1978, he is sitting in the single best seat in Washington for quietly adding a paragraph to a tax bill that nobody will read. So he adds one. The bill it goes into runs close to 200 pages, and none of them are about retirement. The Revenue Act of 1978 is a tax cut bill. Lower individual rates, lower corporate rates, a bigger standard deduction, some capital gains adjustments. Congressman Jim Jones of Oklahoma and Congressman Bill Steiger of Wisconsin were shopping the committee for amendments that would buy bipartisan votes, and Conable offered one about profit-sharing plans that his constituents at Kodak and Xerox had been asking for. A staffer named Richard Stanger did the actual drafting. Stanger worked on 4 benefits provisions in that bill. He later said the 401k paragraph was by far the smallest of them and took the least time to write. Jimmy Carter signed it in November of 1978. The provision took effect on January 1, 1980. Almost nobody noticed because the thing it legalized had a reputation for being boring and marginal. Picture the country that paragraph landed in. In 1978, an American factory worker did not save for retirement. He earned one. A pension in that era functioned as a debt rather than a benefit. It was a legally enforceable promise that on a specific date, a company would begin mailing you a check every month for the rest of your natural life, in an amount fixed by your salary and your years of service. 30 years at the plant, and the plant owes you. That obligation sat on the company's books as a liability, right alongside the money it owed to banks and bondholders. Which means the risk sat on their side of the ledger. If the market collapsed the year you turned 64, the pension fund still owed you the identical check, and the company covered the gap out of its own accounts. Bad markets, long lives, bad timing, all of it landed on the employer. You did not have to know what a mutual fund was, and nobody asked you to guess how long you would live. That was somebody else's math problem, and that somebody had actuaries. And this arrangement did not come from generosity. It came from a wage freeze. During World War II, the federal government capped what employers were allowed to pay in salary, so companies fighting over a shrunken labor pool started competing with everything that was not technically salary: health coverage, pensions. The Revenue Act of 1942 then made those pension contributions deductible for the employer while keeping them untaxed for the worker, and attached rules saying the plan could not exist purely to enrich the boss. Unions spent the next 2 decades bargaining that structure into the industrial economy. By 1980, roughly 38% of private sector American workers were covered by one of these guaranteed pensions. Social Security had arrived earlier, in 1935, and it was never built to carry a retirement on its own. It was a floor, a payment designed to keep an elderly person out of destitution while the pension did the real work of replacing a paycheck. 2 systems, 2 different jobs, and neither one asked a worker to forecast the stock market. A promise, though, is only as solid as the company making it. December 20th, 1963. South Bend, Indiana. Studebaker shuts down its main automobile plant and shortly after terminates the retirement plan covering its hourly workers. The plan is underfunded. There is no federal insurance because federal pension insurance does not exist yet. 10,500 people are in that plan. The 3,600 who have already retired get everything they were promised, and they are the lucky ones. About 4,000 workers between the ages of 40 and 59 receive roughly 15 cents for every dollar of pension they had earned. The average person in that group is 52 years old with 23 years on the line. 23 years of work, 15 cents on the dollar. Another 2,900 workers, everyone with less than 10 years of service, receive nothing at all. I mean, think about that for a second. You are 52, you've given a company more than 2 decades, and the mailbox that was supposed to feed you for 30 years is going to hand you the equivalent of a few years of coffee money. And this was the second time that corporation ran the play. In 1958, it had already terminated the plan covering workers from the old Packard Motor Car Company in Detroit, and those men collected even less than the Studebaker crews would. That earlier wipeout is what pushed Walter Reuther and the United Auto Workers to start drafting a proposal they called pension reinsurance, years before the South Bend gates closed. South Bend became the political engine behind the Employee Retirement Income Security Act, signed on Labor Day of 1974, which set funding standards and created the Pension Benefit Guarantee Corporation to ensure pensions when companies failed. That same law carried a quieter provision that drew almost no attention. It permitted a plan sponsor to delegate investment responsibility to the participants themselves. The legal architecture for putting the decisions in your hands was sitting in the statute books 4 years before the paragraph that would eventually use it. So by the mid-1970s, the pension was finally protected, regulated, insured, backed by a federal agency. Therefore, the pension should have been safe forever. Instead, the same law that saved it planted the seed that would replace it. Because buried inside that reform was a fight almost nobody has heard about. Since the 1950s, a handful of companies had been running something called a cash or deferred arrangement. Simple idea. The company declares a profit-sharing bonus and lets you choose. Take the money now in cash or leave it in the plan and take it later. In 1956, the IRS issued a ruling that blessed these arrangements. A federal court case, Hicks versus the United States, forced a revision in 1963, and the IRS blessed them again. Then the IRS changed its mind. In December of 1972, it proposed regulations that would have gutted the tax treatment of those arrangements and effectively ended them. Which is where the story gets strange, because ERISA, the law everyone remembers as the Great Pension Protection Act, contained a clause blocking Treasury from issuing those regulations. It froze the rules in place, protected the plans that already existed, banned the creation of new ones, and ordered a study of salary reduction plans. That freeze got extended in 1976, then extended again in 1978. Washington kept hitting the snooze button on a small tax question year after year, and a tax lawyer at Ivins, Phillips and Barker named Carol Savage, kept the issue breathing on behalf of clients like Kodak and Xerox. The New York connection handed him 2 allies, Conable in the House and a first-term senator named Daniel Patrick Moynihan. Conable's paragraph was the permanent answer to that decade-long argument. And it did not invent a thing. It legalized something old and unfashionable. The version of the story you have heard leaves all of that out. The 401k was the settlement of a bureaucratic turf war, and the same bill that carried it also created the flexible spending account, which tells you roughly what class of legislation it was writing in. So what does the paragraph actually say? Strip out the legal language and it addresses one specific problem, and that problem has a name. Constructive receipt. Imagine your boss walks up on payday with $100 in his hand. He says he can give it to you now, or hold it in a drawer and give it to you in 20 years. You pick the drawer. The IRS historically is unimpressed by this. Their position is that the moment you had the power to take that money, you received it, whether or not you physically touched it. You cannot dodge a tax bill by choosing not to pick up your own money. Paragraph K carved out an exception. For this one kind of arrangement, inside a qualified plan, choosing the drawer no longer counts as taking the cash. Your money goes in untaxed, it grows untaxed, and the government collects decades later when you pull it out. That is the entire mechanism your retirement runs on. Nothing in that paragraph creates an account, requires an employer to offer anything, or says a single word about how a human being is supposed to live at 80. It solved a tax timing problem for people who received bonus checks, and there the story should have ended. 3 weeks after the law was signed, a lawyer in California read it differently. Ethan Lipsig was outside counsel to Hughes Aircraft, on its way to becoming the largest industrial employer in California. Hughes already ran a savings plan for its workers, funded with money the government had already taxed. Lipsig wrote the company a letter. In it, he laid out, step by step, how that after-tax plan could be flipped into a pre-tax one under the new paragraph, and the Employee Benefit Research Institute has since recognized those pages as the earliest documented appearance of the 401k. Hughes did not do it. The lawyers looked at the legal gray area, looked at the IRS, and decided to wait for somebody else to go first. That somebody was a farm kid from Pennsylvania. It is a quiet Saturday in the fall of 1979, and Ted Benna is in his office at the Johnson Companies in Newtown, Pennsylvania. No phone ringing, no colleagues wandering in. He is a benefits consultant, and he has a bank as a client, and the bank has an unglamorous problem. Its senior executives are getting hammered on their bonuses, because at that moment the top marginal federal income tax rate in the United States is 70%. The bank wants a legal way to soften that. So Benna is reading Section 401, looking for a shelter for a handful of well-paid men. And he turns it sideways. The paragraph says employees can elect to defer compensation. It does not say those employees have to be executives. It does not say the money has to come from a bonus. If ordinary workers could route part of their regular salary into the plan before tax, and if the employer added a matching contribution to pull participation up across the entire workforce so the plan would satisfy the rules against favoring the highly paid, then the whole structure would hold together. Everyone participates, everyone shelters income, the plan qualifies. That match, the thing you probably think of as your company being generous, was engineering. It existed to make the math legal. Benna took the design to the bank. The bank's attorney refused. His reasoning was that this had never been done, and if the government ever calculated how much tax revenue would evaporate, Washington would repeal the provision and leave the bank holding an illegal plan. He was wrong about the repeal, and being wrong cost his client a place in history. Benna could not sell the idea, so he ran the experiment on his own coworkers. On the first day of 1981, the first 401k plan in the country went live at the Johnson Companies. Not a Fortune 500 giant. A consulting firm in suburban Pennsylvania testing a tax theory on its own staff. Under the rules as they stood then, a participant could route as much as a quarter of their salary into the plan, up to $30,000 a year. That is a ceiling written for somebody who has 30,000 spare dollars lying around, which tells you exactly who the drafters had in mind. Benna then used his connections in the industry to talk with Treasury officials about how the thing ought to be regulated. He had built it as a bolt-on. Something extra for companies that already ran a real pension underneath it. 3 decades later, he would look at what it had turned into and reach for a word that startled everybody who heard him say it. On November 10, 1981, the IRS issued proposed regulations confirming that regular salary, not just profit-sharing money, could be deferred into these plans. That was the starting gun. Corporate America did not walk toward this. It sprinted. By the end of 1982, close to half of all large employers in the United States were offering a 401k plan or actively working on one. Johnson & Johnson signed on along with JCPenney and PepsiCo. Kodak and Xerox, the companies whose executives had lobbied for the paragraph in the first place, were among the earliest companies outside of banking to set one up. Now ask yourself why a corporation would move that fast on a benefit for its employees. Look at the balance sheet. A pension is a liability. It is a debt you carry for 40 years, valued by actuaries, funded whether business is good or terrible, insured through premiums to a federal agency, audited, reported, and completely outside your control because you cannot predict interest rates in 2035 and you cannot predict how long your retirees will live. A 401k match is an expense. It shows up in the quarter you pay it, and it is gone. There is no 40-year debt to fund and no obligation whatsoever to the man who worked for you a decade ago. And in a bad year, you can suspend the match with a memo. The same paragraph that built you a tax shelter handed your employer an exit. And the people who would have fought about it were vanishing at the same time. In 1983, 16.5% of workers in private industry carried a union card, and the pension was something a union bargained for at a table. By 2025, that figure had fallen to 5.9%, the lowest on record. Blaming the whole collapse on one tax provision would be too easy, because the other side of the table was emptying out. And in December of 1985, the accountants pushed everyone through it. The Financial Accounting Standards Board issued Statement No. 87, which forced companies to book pension costs on an accrual basis and to carry a minimum pension liability on the balance sheet itself. Obligations that had been sitting quietly in the footnotes of an annual report were suddenly visible to every analyst on Wall Street, moving with interest rates, dragging reported earnings around. A finance chief who had tolerated the pension as paperwork now watched it move the stock price. So the pension did not end in a hearing room. There was never a bill titled the End of the Guaranteed Retirement Act, and no televised debate where a member of Congress stood up and argued that a 55-year-old machinist ought to be managing his own portfolio. The transfer happened through thousands of separate corporate decisions, each one perfectly rational on its own, each one moving a little more risk off a company and onto a person, onto you. If you are finding this useful, subscribe. I break down where your money actually comes from every week. By 1982, Congress had noticed the revenue leaking out the side of the tax code and started tightening the valve. The Tax Equity and Fiscal Responsibility Act cut the maximum annual contribution from all sources down to $30,000. For more than $45,000. In 1984, the Deficit Reduction Act added the actual deferral percentage test, the compliance machinery that stops a company from running a plan that only its top earners use. Then the Tax Reform Act of 1986 dropped the individual deferral limit to $7,000, a cut of about 77%, while building the same kind of plan for federal workers and calling it the Thrift Savings Plan. That sequence is the tell. Congress spent 8 years capping and testing and restricting this thing to stop it from being a rich person's toy. What Congress never did was ask the larger question of what happens when the guaranteed pension underneath it disappears. It was already disappearing. The number of defined benefit pension plans insured by the federal government peaked in 1985 at about 114,400. By 2002, that number had fallen to roughly 32,500. Between 1990 and 2006 alone, sponsors voluntarily shut down more than 61,000 single-employer pension plans that were adequately funded. Those were not failing plans or Studebaker situations. Those were plans with enough money sitting in them, shut down because the company preferred not to carry the obligation for another 40 years. The strange part is what happened to the headcount. Across that same stretch, the number of workers insured by the federal agency actually climbed, from 38 million to about 43.9 million, because the plans vanishing fastest were the small ones. The government insured more than 90,000 small pension plans in 1985 and fewer than 19,000 by 2002. Work for a corporate giant and your pension probably limped on in frozen form. Work for a machine shop with 60 people on the floor and it evaporated. The giants were not exactly healthy either. By September of 2003, federal auditors put the total underfunding across insured single-employer plans at more than $350 billion. And this was not confined to struggling industries. Coca-Cola froze its plan. IBM, Verizon, Lockheed Martin, Hewlett-Packard, and Alcoa were profitable companies in good health, and every one of them froze or closed a pension during the 2000s. In the 1980s, freezing a pension signaled a company in trouble. 20 years later, it signaled a company with a competent finance department. Private sector pension coverage fell from around 38% of workers to roughly 15% today. The man who drafted the first plan was watching all of this happen, and he did not like what he saw. If you were born after about 1970, you never had the option. The system was reorganized before you filled out your first W-4, and the paperwork you signed on your first day was the paperwork for the thing that replaced it. Which leaves you holding 4 separate risks that used to belong to somebody else. Investment risk is the obvious one. Your balance follows the market, and the market does not care what year you turn 65. Sequence risk is the one nobody explains. 2 people can average the identical return over 30 years and end up in different universes, purely because of the order the good and bad years arrived. A crash in your first decade of saving is survivable and possibly even helpful. The same crash in the 2 years before you stop working can permanently reduce what you are able to spend for every year that follows. Vanguard reported that its participants under 45 hold roughly 90% of their money in stocks at the median, and that the average account returned about 19% in 2025. The allocation that produced that gain is the identical allocation that produces the loss, and which one lands on you comes down to the calendar rather than your judgment. Decision risk is you, unsupervised, choosing among fund names you do not recognize. Then there is longevity risk, the strangest of the 4, and the one that makes the pension look like a genuinely different technology rather than an older version of the same thing. A pension pools people. Some retirees pass on early, some live an extraordinarily long time, and the fund's actuaries only need the average across thousands of people to hold. That is an insurance product. It is math that works because of the size of the group. Your account has a group size of 1. There is no averaging. You are asked to estimate how long you personally will be alive, then divide your savings by that estimate. Estimate low and you run out of money in your 80s, with your earning years behind you. Estimate high and you spend your entire retirement being poorer than you needed to be, and you leave money behind. The old system solved this with statistics. The new one hands you a number you cannot possibly know and asks you to plan around it. Nobody has ever explained that trade to you in a benefits meeting. There is also a cost to running money through a financial system, and it is quieter than the risks. Benna tells a story about looking at a plan where the participants were paying 2.75% in annual fees at one of the 10 largest providers in the country. He moved it and their costs dropped to 0.15%. That gap compounds in a way your quarterly statement never shows you. A fee is not a one-time charge. It is a percentage of everything you own, taken every single year, including the years your account is at its largest. Over a full working life, the difference between paying 0.25% and paying 2% can consume a meaningful share of the final balance, because you lose the fee and you also lose everything that fee would have earned for the next 30 years. Nobody sends you a bill. It leaves quietly, in fractions, forever. So how is the experiment going, 45 years after that Saturday in Newtown? Total assets in 401k plans stood at about $10.1 trillion at the end of 2025, easing to around $9.9 trillion by the end of March, according to the investment company Institute. Another $18.9 trillion sits in individual retirement accounts, which is largely where workplace money goes when people change jobs. For scale, the entire American retirement market, counting pensions and every private account, ran to roughly $48 trillion in late 2025. Now open the individual accounts. Vanguard's How America Saves report for 2026, built on millions of participant accounts, put the average balance at year-end just under $168,000. Record high. The median balance, the actual middle person, was $44,115. That gap is roughly 4 to 1, and it exists because a relatively small group of very large accounts drags the average upward. The number you keep hearing describes a saver who barely exists. Among workers aged 55 to 64, the people closest to the exit, the median balance was just over $107,000. Run the standard 4% withdrawal rule against that, and you get somewhere around $4,300 a year, roughly $350 a month, before you account for the fact that a hospital exists. Meanwhile, 6% of Vanguard participants took a hardship withdrawal in 2025, triple the rate before the pandemic, at a median of about $1,900. That climb has a specific cause. In 2018, Congress removed the rule requiring a worker to take a plan loan before qualifying for a hardship withdrawal, and the rate has gone up every year since. People are reaching into the account meant to feed them at 75 in order to avoid eviction at 40. And at Fidelity, the number of 401k millionaires climbed to around 6 to 65,000. One number cuts the other way, and it deserves saying. Vanguard found that 97% of the plan money eligible to be cashed out in 2025 stayed invested instead, which is the opposite of what people assume about job hoppers and retirement accounts. So the system is not failing. It is doing exactly what a market-based self-directed structure does, which is amplify whatever position you are already standing in. And the shelter itself carries a price tag that never appears on your statement. The Joint Committee on Taxation scores the tax breaks for retirement saving as the single largest annual tax expenditure in the federal budget, bigger than the break on capital gains and bigger than the one on employer health insurance. In 2024, that came to roughly $397 billion the Treasury chose not to collect, with about $212 billion flowing through defined contribution plans like yours. And the people standing underneath that money are not who the label suggests. The Congressional Budget Office found that 77% of people in the top fifth of American incomes benefit from retirement tax breaks, against 19% in the bottom fifth. 45 years on, the shelter is still doing exactly what Conable's better-paid constituents asked for, only now it does it at the scale of a continent. Which brings the story back to a farm in northern Pennsylvania, where Ted Benna is now in his 80s, not far from where he grew up with a dairy cow he owned at 7 years old. He has spent years publicly criticizing what his idea became, telling CBS News that he had created a monster, and saying that if he were starting from scratch, he would blow up the existing structure and rebuild it. He has also pushed back on how that quote got used. His argument is narrower than the headline suggested. The original plans, he points out, offered two investment choices, a stock fund and a bond fund, in fixed percentages, which gave a worker 5 possible combinations. 5. A person could hold the entire decision in their head during a lunch break. Today, a typical menu runs close to 20 funds with no restrictions, and his position is that the industry never demonstrated that the extra complexity produced better outcomes for anybody except the people selling the funds. His other point is the one that reframes everything. He never designed this to replace the pension. It was billed as a supplement, an extra layer sitting on top of a defined benefit plan and Social Security for companies that already had both. The tower was supposed to have 3 floors. 2 of them got removed while nobody was looking, and the one Benna built is now carrying the entire weight. The most revealing move came from Congress itself. The Pension Protection Act of 2006 encouraged employers to enroll workers automatically, defaulting them into the plan and into a diversified fund unless they actively opt out. That reversal is the whole argument in one move. The design runs on your choices, starting with whether you opt in at all and ending with which funds you pick. The single most effective repair anyone has found is to remove the choosing. Enrollment rates jump when the decision is made for you, which is a quiet admission that the freedom at the center of the system was never the feature it was sold as. So go back to that paragraph in the tax code, section 401, subsection K. Language that Richard Stanger drafted in less time than he spent on anything else in that bill, that Barber Conable added as a favor to constituents who wanted to keep their bonus checks, that ended a decade-long dispute between the IRS and a handful of corporate tax lawyers, and that a consultant in Newtown, Pennsylvania read on a quiet Saturday and understood differently than the men who wrote it. That paragraph is now the retirement plan of the United States of America, and nobody designed it for the job. The largest transfer of financial risk in modern history happened one corporate memo at a time, off institutions that employed actuaries and onto individuals with a login and a guess. This system works for plenty of people, and pretending otherwise would be dishonest. What is worth arguing about is a country where the outcome turns on, when you were born, what your employer decided in 1986, and whether the market cooperated during the specific decade your career happened to end. You are the pension fund now, funded the way the company that used to owe you a check would have, because there is nobody standing behind you anymore. So now you know where the account came from, who it was drafted for, and what it quietly replaced. Next week I am taking apart Social Security, where the money actually comes from, and why the trust fund does not work anything like the way you were told. Subscribe so you catch it.